Oil prices sliding to their lowest levels in months, a sign that the energy market may be shifting concerns from the possibility of supply disruption in the Middle East to waning demand in the U.S. and China. Joining us now with more is Rebecca Babin, CIBC Private Wealth Senior Energy Trader. Rebecca, great to have you with us. I mean, it's stunning to think that oil is down, 20% from highs in a very short amount of time. Have we moved back to the fear of just deflationary pressures around the world because of weak economies?
Yeah, I think we have shifted our focus from the what if supply is disrupted due to the conflict in Israel? What if China continues to have exponential growth, to what is? And what is right now is a very balanced supply and demand picture. We've come out of a really strong summer driving season where we saw massive inventory draws, but we're in a place now where refining margins have come down substantially, and we're just not seeing the inventory draws that we've seen. At the same time, supply remains pretty robust and hasn't come off. So we're in a place of balance, and I think that shift in mentality and looking at things through the what is, not what could happen, has really kind of taken the wind out of the sails of the commodity. I would say, though, at this point, I think we've overcorrected and thinking about those deflationary fears. And that's partially because we've seen a massive change in positioning from systematic trading funds who were max long throughout the summer and fall to now flipping max short. And we just don't have that natural buyer from the macro hedge fund community who's looking into year end and trying to evaluate how to position for 2024, which looks a little bit more mixed and uncertain.
We've had a lot of volatility in the oil markets alongside the volatility that we've seen in the bond market, Rebecca. And I'm just curious if, when you take a look at some of those, systematic trading firms, et cetera, if there was related linked positioning between the two that is sort of enhancing the volatility in both asset classes.
Yeah, that's a really interesting point because there has been a really high correlation this year with interest rate volatility and crude volatility. And I think there is a link. I don't think we know because CTAs run a little bit more of a black box in terms of how they trade. But clearly, when interest rate volatility picks up, risk appetite across the crude complex gets compressed. And we see traders move from maybe trading in futures to looking to have their exposure in options, right? So when the conflict in Israel took place on October 7th, we saw not an increase in crude open interest, but a massive explosion in options open interest. Nobody wanted to place the bet outright. They wanted the tail hedge. I think we continue to see that. I think interest rate volatility plays into that. And as we head into year end, I think risk appetite in general kind of shrinks, and it's harder for people to really step in and try to catch the knife in crude for a bounce when they're looking at their end of years and they're looking at 2024 and they're saying, okay, demand growth in 2024 looks like 1 million barrels. Supply growth in 2024 for crude also looks like 1 million barrels. Where's the alpha here? And the alpha is really going to come from what does OPEC do at their next meeting and how they kind of fiddle with their supply into 2024 to see if we have those draws.
You had said earlier that you thought that crude overcorrected, and yet we got CPI data from China overnight, which showed a weaker than expected picture there. What is the risk to the upside or the downside at this point?
I think the risk is to the upside, and I did see that CPI data, but I would say this. The crude consumption, the crude demand we've seen in China has really been kind of disassociated from those high-level macroeconomic numbers that have come from China. We are still in the process of kind of recalibrating out of the pandemic in China. And if you look at the high-frequency data, you look at the road congestion, you look at their flight bookings, things of that nature, they actually look to be intact on the demand side. It is a concern, and you're right, going into 2024, I think that people are looking at that and saying, okay, how much of this, how long can gasoline consumption continue to kind of diverge from those macro numbers? I continue to think that they're going to outperform. They've outperformed all year. I think China is going to continue to stimulate the economy and stabilize. And I look at these prices where we are at 75, and I think OPEC stands packed, does not bring back supply, at least in the first quarter of 2024. And we have some SPR buying, and I feel like at this point the risk is to the upside. But of course, there's always that downside scenario where things in China melt and we get a hard landing in the U.S.